So just to give you a little bit of information about me, I have been consulting. I'm a senior consultant here with Elire, which I have been here for a little over 2 years now. I have 20 plus years of actual corporate treasury experience where I was in the private sector. With regards to health insurance was the first. The second was car dealerships and fleet management. And I'm going to I mentioned that purposely because I'm going to refer back to that in this presentation. I am a certified core data with Kyriba application, as well as with the deal capture module, which is the module that they use for loans. I also have expertise in areas of knowledge with regards to implementation of cash management, forecasting, and the like. So a little bit about our agenda for today's conversation. I'm going to give you some information for Elire's industry experience. And for those of you who have been on other sessions today, other webinars throughout the day, this is going to be repeat information that you've heard from all my other colleagues. But we just give you a little bit about who Elire is and where we are in the industry. I'm going to then talk about working capital management. The interesting thing enough is, for those of you who joined us last year, I presented on working capital and what that was. So this is what we like to say short term or shortly of part 2 of what working capital is and the management side of working capital. So we're going to talk about what that is. We're going to look at working capital cycles. We're going to talk about ratio analysis and then overall fundamental analysis with regards to working capital management. And of course, like all of our sessions, we leave it open for any questions that you may have from the audience. And please do not hesitate to ask those questions. And if you can't think of a question now, you have one that you think of after the seminar is over, please do not hesitate to reach back out to us and let us know. We will get you an answer. All right, so just a little bit about Elire, our introduction, our industry experience. We were founded in 2005, based mainly on founding partners' expertise in the Treasury space. As you can see, we provide strategic roadmap guidance to assist with best practices for core business processing, improvement, and we specialize in helping all of our clients unlock the potential of their software investments. Since our founding in 2005, we've supported over 250 Treasury Workstation implementation and advisory projects. We help our clients succeed by partnering with them to efficiently implement, integrate, and upgrade their software investments. We have a deep commitment to excellence and quality, and that is one of our core values at Elire. We are trusted advisors to our clients and thought leaders in the industry, we're recognized as members of Oracle Cloud, Kyriba, and FIS Treasury Management System Product Implementation Program. So we are partners with FIS, Oracle, and Kyriba. Ultimately, our goal is to be a trusted advisor to our clients, supporting those areas that I mentioned, the PeopleSoft process and systems that make their business successful. While we got our start in Treasury, Elire has since expanded to 6 key centers of excellence. And those areas of excellence are Oracle Cloud, PeopleSoft services, our Treasury services, advisory services, managed services, and our newly EPM and analyticals area with our acquisition of Stratalize solution that occurred this year. We have advisory services. We as an organization, but firmly believe with our advisory services, we as an organization firmly believe that along with IT transformation, people and process sides of your organization's change is just as important. Investing in change management and business process information, and that is one of the keys to having a successful cloud migration or application optimization. It is all about increasing an end user's adoption and understand of the system. I mentioned managed services as one of our 6 areas, and I'd like to, again, expound on that just a little bit. It is really essential to understanding what does a post-go live support look like when our clients have gotten to that point of ending their implementation and are now utilizing the system in a production environment. We want you to know that our managed services team um, is there for you, and that is the point of after you go live, we still are there to support you in your need and understanding of your treasury management system. So, as mentioned earlier, Elire is a partner with Oracle Cloud, FIS, and Kyriba Services. We also provide treasury advisory services, on-prem treasury workstation systems, and lastly, once a client is in the production environment, as I just mentioned, we also have that managed service area. Keeping in mind that, again, our areas, we have done over 250 implementations in any of these one areas. So again, our knowledge is definitely profound. So here is just a sample of some of our valued clients that we have worked with over the years. We're very proud of the work that we have done to earn these clients' trust and continued businesses. So what you'll see on this slide here is we are across a large area of industry. So we're not specifically honing in on a certain industry. We, as you see, we have some very large name organizations like General Motors, which is something that is widely known, as well as Geico and Vanguard, just to name a few. So now let's get into why you guys actually joined my session for this afternoon. So we're going to talk about working capital expanded and how to leverage working capital for better decision making, because that's our ultimate goal, is to have all the information we need to make better decisions with regards to our organization. So in my previous session that I did last year at ETE, we talked about working capital. Now, this time we're going to discuss working capital management. You may ask, well, what is working capital management? That is considered or defined as the process of ensuring a company is using its financial resources in the most effective way possible. And as someone who worked in the treasurer's department, that is our ultimate goal, is to make sure we are effectively using the cash we have on hand. So in order to know how to manage your working capital, again, hence working capital management, you must first know, well, what is working capital? So you may ask yourself exactly that. So from our previous presentation last year, we define working capital as a company's working capital refers to the capital it has left over after accounting for its current liabilities. Working capital is critical as it is used to keep a business operating smoothly and in a position to meet all of its current and short-term financial obligations within the coming year. So now that we've defined working capital, we then want to know, well, what is working capital management and how does that coincide with each other? Well, working capital management is a business strategy that's designed to manage a company's working capital or a strategy that companies use to manage their leftover cash. So it ensures that a company operates efficiently by monitoring and using its current assets and liabilities to their most effective use. The efficiency of working capital management can be quantified using ratio analysis that we're going to talk about later, or simply put, the use of key performance ratios such as working capital ratio, inventory turnover ratio, and the collection ratio. So you may ask, well, what are some benefits or considerations of working capital management? Some of those benefits are you're going to, by using working capital management, you're going to improve your cash flow management. So you're going to have a better understanding of your cash flow ins, which would be your receipts, and your outflows, which are your disbursements. You're also, some of your benefits, you're going to enhance your earnings quality by using resources efficiently. Again, you'll hear that word probably more than you would like to, but efficiency is the key when it comes to, again, working capital in any treasury department. I always believe, efficiency is more important than working hard. I always say you work smarter than harder. That comes in with that efficiency piece. Some of the considerations of working capital management are the strategies may not always materialize due to market fluctuations. So you have to take that into consideration and where we are. Just recently, things have been a little volatile. I believe as of, I think it was Monday, we know what occurred over in the Japanese market, which in turn, again, ultimately is a trickle down effect and has affected us here in the US. One of the other considerations that you need to take into account when it comes to working capital management is your short-term gains shouldn't sacrifice long-term success. So always remember that. All right, now, Maddie, we've come to our first poll question. I'm going to hand that off to you.
All right, you should see the first poll question up on your screen. Does your organization currently track working capital? Yes, we do. No, not yet, but we're looking into it, or this is not applicable for our organization. We'll give people about 10 or 15 more seconds to get their answers in. Looks like the vast majority of people are answered yes, that their organization currently does track working capital. 10% of people is the next highest with not yet, but we're looking into it.
Good. That is actually a good response. I did not expect it to be that high. And I say that because personally, when I was in the Treasury world, we did not discuss working capital. We just knew what came in that day, and we knew what was going out the door, and whatever was left, we either loaned it to another subsidiary in our organization, or we put it in something like a money market, or long time ago, and I'm aging myself, when we did commercial paper. So that's good that you guys are tracking it. You are being very conscientious of your working capital, and again, how that is affecting your day-to-day processing. That's very good. So some of the working capital management components are your cash. Simply put, how you track your cash and your cash needs. Usually it's done by forecasting, monitoring cash balances, and optimizing cash flows to ensure that the company has enough cash to meet your day-to-day obligations. Those day-to-day obligations can be stuff as simple as payroll, as accounts payable for that day, and that's something that you can control. So those are the things that you would consider enlisted under the area of what you have to meet your day-to-day obligations. One of the other components of your working capital management are your receivables. Those are the manage those credit policies that you have with your customers, your customer payments, meaning that money coming in, and improve the collection practices. So again, you may give a client a discount or a less than interest rate if they pay prior to the due date, or so many days ahead of time. Another component is your accounts payable. Most companies have control over what vendors they pay, how those vendors are paid, and what those credit terms are, and when cash outlays are made. Those are those things that, again, we have control over when looking at working capital and how we're going to manage that working capital. And lastly, another component would be your inventory. And that can be the most risky piece, or the riskiest component of your working capital management. It's due to the market and the consumer preferences. So we all know there are times where things are more sought out in the retail industry, or in goods and services in general, than maybe what they were 6 months ago, a year ago, so forth and so on. So again, inventory plays a part in your working capital management, but again, you have to see where the fluctuations and where things lie. Some of the key takeaways of your working capital management is where you want to require monitoring a company's assets and liabilities, as we talked about before. That's how you define what your working capital is. You want to maintain sufficient cash flows to meet your short-term operating costs and your short-term debt obligations. Another key takeaway is working capital management primarily revolves around managing those 4 components we talked about of what creates working capital, which are cash, accounts receivable, accounts payable, and inventory. Working capital management also involves tracking various ratios, including the working capital ratio, the collection ratio, and inventory ratio. Working capital management can improve a company's cash flow management and earnings quality by using its resources efficiently. And lastly, working capital management strategies may not materialize due to market fluctuations and may sacrifice long-term successes for short-term benefits. Again, keeping in mind that consumer fluctuation also has an impact as well. So we're now going to talk about working capital cycle. This was also mentioned in my previous presentation last year. What is working capital cycle? Something to consider when developing the proper working capital management is a good working capital cycle. And we define a working capital cycle by it represents the period measured in days from the time when a company pays for materials or inventory to the time when it receives those payments for those products or services that it sells. So for instance, working capital cycle, as an example, you have inventory that sits maybe for, let's say, 60 days. You add the receivable days, that's maybe 30 days before you get the money for that product, goods, or service. And then you subtract your payable days, which it took you maybe 15 days to actually pay for that product, good, or service. So here's your formula here. As you can see, I provided that for you. Also, understanding that companies may rely on this cycle when it comes to proper working capital management. Again, all depending on your goods or service that you provide. And you utilize something known as cash conversion cycle, which is the minimum amount of time required to convert net current assets and liabilities into cash. So my next slide just gives you a nice little graphic as what we just talked about, which are working capital days. Sometimes if you put things to pictures, it kind of helps with and give you an illustration of how to understand what that working capital cycle is. All right. So some of the additional cycles that we can talk about in working capital management are your inventory cycle. And what is that? Well, that represents the time it takes for a company to acquire raw materials or inventory, convert them into that finished good, and then store them until they are sold. Another cycle you'd want to consider is your accounts receivable cycle. That represents the time it takes for a company to collect payment from its customers after it has sold goods or services. And then your accounts payable cycle represents the time it takes for a company to pay its suppliers for the goods or services that it received. All cycles affect working capital because the company's cash is tied up one way or another in one of these cycles. So we are going to now start talking about ratio analysis, what it is, and how it benefits working capital management. So Maddie, we're actually on poll question number 2. So if you want to kick that off for me, I'd appreciate it.
So this one is more of a knowledge check, just for fun, see kind of what background our audience has. But we have the question, what is ratio analysis? Ratio analysis is a quantitative method of gaining insights into a company's liquidity, operational efficiency, and profitability by studying its financial statements, such as the balance sheet and income statement. Ratio analysis, this is the second option. Ratio analysis is only used during an acquisition. 3 involves 5 types of ratio calculations. And 4, the option all of the above. So it looks like most people are participating in this poll question. And this one's kind of an incorrect or correct answer. So it looks like 81% of people are answering correctly, with ratio analysis is a quantitative method of gaining insights into a company's liquidity and operational efficiencies.
I love my participants whenever I do a session because that means you guys are listening. Or you already know some of this information, which is great because you may use ratio analysis in some of your working capital management or just in your day-to-day to understand what you need to do. Because again, you guys told me earlier, you track your working capital. So you are very much aware of what needs to be used in order to keep your working capital in a good position. I'm very, very pleased. So what we want to talk about is, again, like I said, what is ratio analysis? Well, additional areas that will help with proper working capital management is the use of ratio analysis. It is a current ratio is defined as a liquidity ratio that measures a company's ability to pay short-term obligations or those due within a year. So we talked about a ratio analysis, that quantitative method of gaining insight into a company's liquidity, operational efficiency, and profitability by studying its financial statements, such as the balance sheet and the income statements. If you chose that in our poll, in our knowledge poll, then good job, thumbs up to you. You knew exactly what a ratio analysis is. Keeping in mind, it's a cornerstone of fundamental equity analysis, which we'll talk about in a few minutes. Some of the ratio analysis involves following areas that you want to look into. Again, there's plenty of ratios that you can use when coming to overall ratio analysis, and I just named three, which is a current ratio, your gross profit margin ratio, which gives a percentage that indicates how much revenue a company keeps for each sale after deducting all costs. And I provided the formula for you. So it's a revenue minus cost of goods sold all over revenue times 100. Because again, you're looking for that percentage. And then lastly, one of your other ratio analysis that you want to include or can include when looking at working capital management is your inventory turnover ratio. So those ratios that I mentioned, some additional ones, your working capital ratio, that is a measure of a business liquidity calculated simply by dividing your business's total current assets by its total current liabilities. There's also a collection ratio, which measures how efficiently accounts receivables are collected. This ratio tells you how often you collect on your accounts, and it tells you how long it takes for you to collect those accounts from the time the invoice is issued to your customer to the time you actually get paid for that good or service. If the average of the collection ratio is low, then that's a good sign that you are on the right track with your working capital management. Because remember, ultimately, we want our cash and our capital to work efficiently. All right, so that means we want to make sure we have enough to pay all our bills, and if we have excess, we know what we're going to do with it. But the goal is to have enough to pay those bills for any given day. So an inventory turnover ratio, one of the last ratios that I mentioned here, evaluates inventory management efficiently by looking at the rate the inventory stock is sold, used, or replaced. It is calculated by dividing the cost of goods by average inventory for the same period of time. A higher inventory turnover ratio tends to point to strong sales. And if the low ratio is low, then that indicates weak sales. So you kind of want to be somewhere in between, because that means you have enough inventory on hand to meet the needs of the customers. So why is the current ratio important? Well, it indicates how well a company can meet its short-term obligations. It measures liquidity or the ability to pay off current debt obligations without raising external capital, meaning you don't have to go out and I'll use an example. I used to work for a fleet management company, and because the inventory was cars, because it was a car dealership as well, that's what we used to go out and get asset-backed securities. That's what we used as our collateral to go get that external capital that we raised when there was times that we needed to look at our working capital and if we didn't have enough to meet our obligations within a short period of time. If a company has a current ratio is less than 1.0, that means that the short-term debts and bills exceed current assets, which could be a signal that the company's finances may be in danger. So I give you a little graph over here to the side that just lets you know that if, again, what it reinforces what I just mentioned here, that if it's 1.0, then you may not meet your short-term obligations. Your ideal ratio is anywhere between 1.2 and 2.0. That's where you want to fall, because that means you have enough capital to, again, meet your current assets and current liabilities. And then if it's above 2.0, then that means you're not utilizing your cash efficiently. That means you have too much revenue on hand that you're not utilizing in the best way. So the importance of inventory ratio, which was one of the other ratios that I mentioned, it shows how efficiently a company sells its inventory. Low ratio compared to industry peers indicates a risk that inventory levels are high. Too much inventory on hand, sales are low. So again, you kind of want to look at industry standards or what others are doing with regards to your organization and where do you fall. And again, adjust accordingly. High ratios compared to industry peers may indicate inadequate inventory levels. It may mean you don't have enough inventory on hand to satisfy that supply and demand. Customers may go elsewhere to get what they need or want. And a very good example of this, again, I'll go back to that car dealership example that I use. There was a time, and you all know, when the pandemic hit, we experienced supply chain finance issues. And that means we could not get cars from overseas to satisfy our customers that needed cars, whether their leases were up or they just needed new vehicles because they needed to get to work. Or again, if we're on the fleet management side, we had a company that needed new fleet of cars because what they had was giving them problems, causing too much maintenance. So they needed to replace their fleets. So there was a struggle there at that point in time where we had to look at inventory ratio and see how or what we needed to do, because ultimately, guess what? That impacted our working capital. So some of the key takeaways of ratio analysis are: ratio analysis compares that line item data from a company's financial statement to reveal insights regarding profitability, liquidity, operational efficiency, and solvency. As one of those ratio analysis, you can mark how a company is performing when you utilize a ratio analysis of any of those that we talked about over time while comparing a company to another within the same industry or sector. So car industry, you want to look at another industry, another dealership or something like that, and see how they're faring. Or even with regards to a dealership and cars, we'll say maybe a brand, BMWs versus Mercedes, a high-end luxury, see how their sectors are going and how they're coming up fairly with ratio analysis. Because you never want to compare apples to oranges. All right. I always want to look at apples to apples. Also, with regards to ratio analysis, while those ratios offer useful insights into a company, they should be paired with other metrics to obtain a broader picture of a company's financial health. That is why I gave you multiple ratios to utilize when looking at your company's financial health. All right, so something else that we're going to talk about with regards to working capital management is valuation. So, what is valuation with regards to working capital management? Well, it is defined as the analytical process of determining the current or projected worth of an asset or a company. So, valuation regarding working capital management, the process by which you give a monetary value to a company. Some of the reasons why you do valuations of a company and you want to give that monetary value is if you're bringing on new investors. So, if you have some investors that are interested in looking into your organization, you want to make sure you have proper valuation for that for your company, so that as a new investor coming in, I know what I'm getting into and what the value monetarily this company has. I also want to consider valuation if I'm going to be selling off assets or portions of the business. So if your business manufactures multiple things, maybe you're going to sell off a portion of that business or one area that you manufacture versus keeping the others. You're going to look at valuation on your organization if you're going to sell the company overall. So if you're looking to be acquired by somebody else, then you're going to give a valuation to your organization. If you have a partner that's exiting out of the organization, you want to put a value on that because maybe, they are going to be bought out, or there may be some shares involved. So you need to consider that, and you want to give your company a monetary value. You also want to look at not only if you're selling the company, but if you're purchasing a company, if you're acquiring somebody, you want to consider that and put a monetary value. So, if who you're purchasing, they know they have value and they're going to, their working capital and their in is not going to be affected greatly because they're being purchased by another company to the extent where they cannot meet their day-to-day obligations that we talked about earlier. And then lastly, your reasons for evaluation is there may be some point of inheritance. So there may be some family members or individuals that are going to inherit some part of the company, and you need to put a dollar amount on the company's value. So some ways that you would utilize or use valuation models in creating that monetary value would use an absolute valuation model. And what is that? It's the attempt to find the true value of an investment based only on fundamentals. And what would those fundamentals mean? What do they comprise of? Well, fundamentals means you only focus on things like dividends, cash flow, and the growth rate of the organization. Examples of absolute valuation models are your dividend discount model, a discounted cash flow model, residual income model, and an asset-based model. Now, I didn't give examples or go into detail about those models, but any of those models, you can probably Google them or go out on Investopedia and find out what they are, or any other, financial institution. You can be able to find what those models are and those formulas. So some more types of evaluation models is a relative valuation model. And what is that? Well, that operates by comparing the company in question to other similar companies. And again, as I mentioned earlier, comparing apples to apples. This model involves calculating multiples and ratios. So you're going to do price to earnings multiple is a valuation metric that compares a company's stock price to its earnings per share. And again, I give you just a little visual or illustration of how you would create or use the price over earnings ratio. And then here's, of course, your formula. It is your stock price divided by your earnings per share. So some additional valuation methods that can be used are the comparable method, which is a method that looks at similar companies in size and industry and how they trade to determine a fair value of a company or asset. You can use a asset-based method of valuation, which is a method that adds up all the company's asset values, assuming they were sold at fair market value, to get the intrinsic, I knew I was going to do that, Maddie, value. All right. Discounted cash flow method is a method that uses discounted cash flow inflows and outflows generated by said asset to get a fair value of a company's intrinsic value. The reason for the discounted cash flows is due to the assumption of interest rates and or the lowest possible rate of return on said investment. And another method for valuation is the precedent transactions method, a method that compares the company being valued to other similar companies that have recently been sold in that same industry. So this method is used mostly in mergers and acquisitions. Some of the limitations of valuations, well, if you think about it, they're not many. But you must consider the best method suited for each individual situation. So again, those methods that we talked about a few minutes ago may work for one industry type, but may not work for another. So each stock is different. Therefore, each industry has unique characteristics that would then require the use of different methods or the combination of various methods. So you may use one or two different ones. Keep in mind that different methods will produce different values for the same asset or company, and that may lead analysts to use the technique that gives the best outcome, which in turn may not be the most accurate. So always keep that in mind. That's why there are so many different ratios and valuations to use when looking at a company and, its working capital and its management, and placing that intrinsic value on that company. So one other area that we're going to talk about is fundamental analysis. And what is fundamental analysis? Well, it's a method of determining a stock's real or fair market value. It is often used to measure a security's intrinsic value by examining related economic and financial factors. The intrinsic value is the value of an investment based on the issuing company's financial situation and current market and economic conditions. Fundamental analysis study anything that can affect the security's value, from macroeconomic factors such as the state of the economy and industry conditions to microeconomic factors like the effectiveness of the company's management. The end goal is to determine if a stock is overvalued or undervalued by the market, and is mostly used for long-term investments because it can help investors understand what price a stock should reach and assist with identifying companies with strong growth potential. All right, so to give you a little understanding, I gave you an illustration on one of the fundamental analysis and the method that is determined how you would determine the intrinsic value of a company's security to benefit from its trading. Again, I just mentioned the macroeconomic factors, and you have the economy, industry, market share. And then you have your microeconomic factors, which is management, business policies, and earnings. And all of that plays a part in the intrinsic value of a company's stock, which then again, as we just mentioned in the slide before, all this is again just a illustration, will help with their stock selection. Keeping in mind, if a stock is undervalued, that means that the intrinsic value is greater than the stock price. So you want to buy that stock or buy into that company. But if the valuation or through fundamental analysis is overvalued, then that means that the intrinsic value is less than your stock price and you want to sell or refrain from buying any. Another help with fundamental analysis or illustration that I also provide to you guys is the breakdown between your quantitative and qualitative analysis with regards to overall fundamental analysis. And what you'll see is your qualitative side, which is usually refined as quality, means your management quality, your regulatory environment factors, business models, corporate governance, and industry and competition. With regards to the quantitative side of things, that is usually defined by numbers. So you're looking at your financial statement analysis with regards to balance sheets analysis, your annual reports, profit and loss statements, income statement analysis, and cash flow statement analysis. Also, under that quantitative analysis, when looking at financial statements, you also want to look at profitability ratios. And here's some of those additional ratios that I didn't mention earlier, but can be used with regards to analyzing valuation and any ratio analysis overall. You know that profitability ratios, leverage ratios, projected earnings, value ratios, efficiency ratios, and solvency ratios. And last illustration that I have for you guys are some of the steps to do, or what are the steps to do when it comes to fundamental analysis? Well, you can take two different approaches to it. You can look at the bottom-up analysis, which starts with a specific industry. Then you go and look at the industry, the sector, and then overall economy. Or you can look at it from the top-down analysis perspective. So you're looking at, again, the opposite direction. You're looking at overall industry initially, then breaking it down to sector, industry, and then specific company. So some of the key takeaways of valuation and fundamental analysis are fundamental analysis, a method of determining a stock's real or fair market value. Fundamental analysts search for stocks currently trading at prices higher or lower than their real value. If the fair market value is higher than a market price, the stock is deemed undervalued and a buy recommendation is given. And that coincides with the previous slide where I showed you that illustration. If the fair market value is lower than that market price, the stock is deemed overvalued, and the recommendation might be not to buy or to sell if the stock is held. In contrast, technical analysts favor studying the historical price trends of the stock to predict short-term future trends overall. So some of your limitations when it comes to working capital management is you're only focusing on those short-term assets and liabilities. All right, it does not address long-term financial health of a company. You may sacrifice the best long-term solution in favor of short-term benefits. You cannot guarantee success of working capital management. Again, it's about looking at trends, ratios, how it all plays into your organization. It may not lead to increased profitability overall, and it does not inherently increase profitability. It makes products more desirable, or it increases a company's market position. What needs to be done with regards to working capital management is companies still need to focus on sales growth and focus on cost control. So as the bottom line improves, working capital management can simply enhance a company's position. So our overall key takeaways from today's presentation are: one, the bottom line is working capital management is at the core of operating a business. And if you're not currently talking about the proper way for working capital management, that might be something you want to consider and talk to the necessary individuals. The good thing is, majority of you guys on this presentation today told me you are tracking your working capital. So that's a very good start. The next thing, and I'm going to actually give you some steps on how we're going to implement our working capital management in a second, but we're going to finish our key takeaways. Our second key takeaway is without sufficient capital on hand, a company is unable to pay its bills, process its payroll, that's definitely not a good sign, or invest in its growth and future growth. Your third key takeaway from today's presentation, companies can better understand their working capital structure by analyzing liquidity ratios and ensuring that their short-term cash needs are always met. And lastly, with the end of low interest rates, free flow lending, and easy access to capital, it is required more than ever that organizations have a working capital plan in place that would be a key role in proper working capital management. So you might be asking yourself, well, Sandra, you gave me all this information. That's all fine and good, but how am I going to go about implementing working capital management at my organization if I'm currently not doing it? Well, one, you want to define what working capital is for your organization. Remember what working capital is defined as, and that it is your capital is your assets minus your liabilities. You also want to consider the components of those working capital management, which we talked about was cash, accounts receivable, accounts payable, and your inventory. Look at all of those areas combined and discuss with those key people from those areas on how these components will impact working capital and working capital management. You want to perform the necessary ratio analysis in all areas of your organization to see how your organization compares to the industry standards. And lastly, you want to make better, because that's the title of our presentation today. We want to make better and informed decisions on how to move forward for our organization that you may have maximized your working capital and benefited from that working capital management. So that is actually the end of my presentation, guys. I appreciate your attention. We're now going to open up to see if there's any questions.
Any questions in the Q&A just yet? If you have some, feel free to drop those in the next minute or so here. Otherwise, you can reach out to ete2024@elire.com and we can follow up with you individually there. Thank you all for joining the Elire Treasury Experience and for joining this session. So our $5 Starbucks gift card winners for this presentation are Randy Wiggins, Dustin Senger, Richard Estones, Jessica Seawright, and Jared Gray. Recordings of the session will be sent to attendees via email in the coming weeks, as will the CTP exam certificates that those who attended live and passed the CTP credit quizzes with a score of 80% or higher earned. Starbucks gift cards will be sent via email later this afternoon to those who won those in our polls. Thank you to those who have been providing feedback after each session via the Zoom surveys as well. Your insights are valuable and have helped this event change and grow over the past 5 years into the format that we have today. An overall post-attendee survey will be sent to you along with the recordings in the next few weeks as well. And we organizers and the presenters value your honest feedback there. If you have any questions for our team, please reach out again to ete2024@elire.com and we will get back to you. Thank you all for a great year of the Elire Treasury Experience. We hope to see you again next year.
Thank you so much, guys. Have a good one.